7:43, welcome back. A big announcement yesterday from the Federal Reserve. They cut its benchmark interest rate for the first time since December. So what does that mean for borrowers and savers? Joined this morning by certified financial planner Derek Williams. He's going to walk us through what it means. Good morning to you.
Morning, thanks for having me.
So a gradual decline here, but it's a big policy move.
Yes, it is, just because they haven't moved rates in almost a year. So you see 0.25% getting moved. So that's going to affect a lot of things from mortgages, credit cards, these high yield savings accounts. There's a lot of things that are going to be affected.
So that's where we're going to see, you're going to be seeing some impact here.
Yeah, absolutely. I think one of the first things is mortgages. I know a lot of people have been waiting for that relief. So those actually declined in the wake of thinking that the Fed was going to decrease the rates. So you saw that, and one big thing that I know a lot of people use is that home equity line of credit, and that's a floating rate actually depending on what the Federal Reserve does.
Right.
So that's going to be a big relief for those borrowers as well, because you're going to see that immediately decrease, as well as people who have credit cards. You're going to see hopefully those rates decrease as well over time.
This is the first cut in what just might be multiple cuts to come into next year. What are you hoping and looking at?
It's looking like last week when the Fed, spoke, and depending on what kind of data they get, over these next few months, they meet again in October. But kind of the consensus is we're going to see 2 more cuts this year. We don't know quite yet if it's going to be a 25 basis point or a quarter of a point, and then another half of a point, because last week they thought about, maybe, half a percentage point. So we'll see what that's like, but we're going to see 2 this year before 2026 or 2025 ends, and we're going to see 1, into next year as well, from what they said at their meeting last week.
Yeah, did you see these coming?
Yes, I did. Yeah, just with inflation on the rise and employment not where the Fed wants it, that was definitely a big kind of point of consensus, as they want to get more growth into the country. They weren't as worried about the tariffs as we thought, but with employment staying kind of pretty stagnant, they definitely want to get some more growth into the economy.
So talking about where you're going to see some impact here, where won't you see any?
You won't see impact immediately for maybe some of those long-term kind of savings things. Because one of the downsides of the Fed cutting rates is those who love those kind of high money market yield and high money market savings accounts are going to see those decline. But if you've got one of those rates that's locked in for 12 months or longer, you're not going to see as much of a move in those. But with kind of this day-to-day, like the HELOC and getting a small business loan next week, you're going to see that increase or decrease immediately.
You often look at what the impact of this can be. Will people start to borrow again? Will it make for some better news on the housing market? How long does it take for us to see any results there from that perspective?
From that perspective, it depends on how quickly they do the next cut. Like again, you've already seen mortgage rate, for example, start to decline because there is already more anticipation for the rates to be cut again. But with brand new loans, you will see that effect immediately. But when it comes to loans that are maybe 5 to 10 years out, it's going to take a little bit of time to see those affected when people are making new applications, as well as refinancing some of these loans as well.
So that's what I'm getting at now.
Yeah.
So you're seeing this rate decline. Should I wait for the next meeting, or can I go through the process of refinancing now?
It certainly depends on your situation, but if I'm a borrower, I wait to see if we see as much of a 50-point decrease within the next meeting, as well as we might see as much as 75 basis points before the end of the year, which means a month ago we saw 4.5% for a loan, and you might see 3.5 by the end of the year. So I would stay patient and see what the Fed does.
All supposition, but what does your spidey sense tell you the Fed's going to do?
Spidey sense tells me it's not going to move it as much as we we like.
All right, Derek, thank you. I do appreciate that. Of course, Derek's in every couple of weeks to give us the financial advice, so thank you for walking us through that.